Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. I'm personally looking for potential multi-baggers, folks, types of stocks that could potentially go up hundreds or even thousands of percent over time. How do you find those types of companies? The trick is to find companies that could potentially grow at high rates in the years ahead. Now, how do you find those types of companies? In my opinion, the trick is to find potentially unrivaled companies, because if you're unrivaled, it means you have the right to win longer term. It means you have the right to beat out competition. And if you're growing faster than the competition, it's very likely that you can grow at a faster clip. And if you're growing at a faster clip, there's a good chance shareholders will benefit as well at a better return over time. And today we're looking at a company that I believe is unrivaled. Today and it's fast growing too, projected to grow about 50% this year. Today we're looking at Progyny, PGNY stock, and I want to call out Dennis, who's an Unrivaled Investing Journey subscriber, because he was like, hey Daniel, here's the reason why I think it's unrivaled, here's the valuation why I think it can double, and I think he's broadly right. We're going to talk about that in just a minute, talk about valuation later on. First up, what is Progyny? And if you want to follow my personal journey as I look for potential multi-baggers, go to unrivaledinvesting.com. Let's dive into Progyny right now. Where, in order to understand Progyny, they are a fertility benefits manager, and they've quickly grown to cover about 2.7 million lives. Those are employees across 180 clients. That's about these companies effectively employ between 10 and 20,000 people, and they've rapidly grown. Progyny has rapidly grown to about 3 to 4% of their target market. So this figure, rapidly growing from effectively nothing in 2016 to capturing 3 to 4% of the U.S. market in such short order, makes me think this does have multi-bagger potential. Could they be 8%, 12%, 40% in the future? That's what starts getting me excited. And then plus seeing another key metric where they talk about near 100% client retention since 2016. This means their customers, which are these employers, love them. They're sticking by them. So let's understand them in a little bit greater detail. But first, you should understand who are their customers, such as Google, Microsoft, PayPal. These are some of the major name brands. And to understand what drives their growth is partly to understand these customers, because these top employers are in a war to attract talent. Not only attract it, but to also retain the best talent. So once a top player in an industry acquires, starts using Fertility Benefit Manager, saying, hey, we're going to use Progyny, they're now they've set down the gauntlet. They're saying, hey, they've thrown it down. They're saying this is the gold standard for employees. And so if Google does it, now Microsoft needs to do it. And so this becomes sort of table stakes for certain industries, because you have the best players say, hey, this is how we're going to treat our employees. Don't you want to treat your employees with the gold standard as well? And so to understand the field that they're operating in, one should first understand that about 1 in 8 couples have infertility issues. So that's around 12% of couples out there. And this is increasingly recognized as a challenge for many people. And so you have about 50% of large employers providing some type of fertility coverage. That's expected to grow over time. And this sort of you have these macro tailwinds, which I'll be talking about in a second, is broadly driving a field, an addressable market that's around $7 billion that they think has the potential to grow around a 10% CAGR. And so some of these tailwinds include mandated insurance coverage for infertility. For example, only 19 states in the U.S. currently have mandated insurance coverage for infertility. That figure could double over time. Then you have the aspect that more couples are having babies older, and this is sort of a byproduct of more women looking to work in the workplace, and which is great. And they're sort of saying, hey, I want to postpone having children for later. And the challenge there is, if the longer you postpone, the harder it is to have babies. And another aspect of a macro tailwind that you're looking at with Progyny is that the number of babies born using artificial reproductive technology is around 2%, versus, let's say, other developed countries like Japan or Denmark, which has more of a country societal buy-in to support infertility issues, where here it is, artificial reproductive technology is about 5 to 10% of babies born in those countries. So you're looking at a growing industry that Progyny is operating in. You're looking at potentially high single digits, potentially low double digits, just inherent tailwind that they're growing in. And to understand the problem that they're solving, one should first understand, let's do a case example that they provide where Sarah, she's been trying to conceive, she spent $20,000. She has a $20,000 fertility benefit. She's been mandated to do the in uterine insemination type of treatment. She fails 3 cycles of doing this IUI and exhausts most of her benefit, this $20,000 benefit. So then she's like, oh shoot, I had to do this type of treatment. And the reality is a lot of folks don't realize that there's more than one different type of treatment that she could pursue. And so then she goes, okay, well, this didn't work. So now, instead of the in uterine insemination, she's going to say, hey, I'm going to take out a loan to do IVF. And she skips the genetic testing because now it's on her own nickel. She already used up that $20,000 benefit. And so because, she, let's say, didn't do the genetic testing, unfortunately, she gets pregnant but then miscarries. And so then she's, so now you have an employee that's upset and distracted with sort of the turmoil in her life. And so then she says, hey, I'm going to insist that I have multiple embryos be transferred this next time when I'm doing IVF. Once again, she's getting further and further in debt. Really big challenge. And so now, because she had multiple embryos transferred, now she's looking at twins potentially, and they're delivered at 36 weeks, so they're early, and it's a cesarean section or a C-section because it's a twins. So now the employer and the employee are dealing with higher costs because you have the C-section, you have NICU costs, so effectively preemie babies that you have to deal with special costs there. And then you have, the employee's probably exhausted from the ups and downs, the emotional roller coaster. So she might take a 9-month unplanned leave just based on how challenging this is. This is a lose-lose framework because there's a whole lot of costs and procedures that didn't need to happen necessarily. The employer is not happy that she's taking this leave after running up a bunch of costs. She's not happy that she's in a ton of debt and now she's having to take a leave and she has this debt. This is just a lose-lose framework. And so you have this growing industry that one could argue is poorly served. And so that's where Progyny steps in with potentially this unrivaled model. And it's unrivaled with several different angles. But they, instead of using this sort of, hey, here's your dollar cap benefit, they use this thing called smart cycles. And they treat it as a currency where you could say, hey, you're the employer, you can say how many cycles you want. And these cycles effectively are converted into other things. So you could have IVF fresh transfer, IVF freeze all the eggs. That's 3/4 of a cycle. And then you can have frozen embryo transfer, which is another quarter of a cycle. So you could say, oh, okay, that's one full cycle. And you could see how or egg freezing is half a cycle, or donor egg with fertilization. That's another half cycle. So you can see how they look at this. And the reason why this advantage is it replaces the dollar max concept with all-inclusive treatment. And this includes the physicians effectively saying, and keep in mind, they have specialists. There's a specialist network that Progyny works with, effectively saying, hey, what's best for the patient? And the reason why this is so important is the patient, the employees of these companies, when they're getting into this, they're never going to get into a position where they exhaust the coverage mid-treatment. They know exactly what they're signing up for. Oh, okay, I've got 2 cycles that I can go through, so that means I can do this, this, and this, and this, and okay, that's what I'm going to do, and that's going to be my shot. And another key aspect that makes this unrivaled is this is pre-tax versus post-tax, which some competitors effectively offer a post-tax solution. It's sort of nuanced. It effectively means that the individuals pay tax on the reimbursements that they have here. Either way, pre-tax is an advantage. I look at this as effectively an unrivaled business model because you're changing it in a different way. You're effectively saying, hey, let's look at this as different types of currency. Okay, you have this smart cycle currency, and you're empowering the customer, you're empowering the patient to get the best treatment possible. And to see how this translates, okay, so Sarah has been trying to conceive, the same girl, and she has 2 smart cycles that's provided through her employer. So then she talks to her physician. What does her physician recommend? It's not a mandate saying, hey, you got to get IUI. Here it is, this physician, the specialist might say, you know what, I actually recommend the IVF freeze-all with a frozen embryo transfer, and that uses 1 cycle, as you can see here. And so then, oh, okay, but this also includes genetic testing and every service she needs. So that way there's no fear, oh, okay, I'm going to hit this $20,000 cap and, let's just skip on the genetic testing. This gets included because you want to make sure you're doing it right. And so then she transfers a single screened embryo because this is what she started with from the first place versus a mandated different process that ultimately didn't work. The physician might say, hey, IUI might not be right for you. Maybe you should start with IVF. two very different types. And so she looks at this, okay, we do this. She transfers a single embryo versus the prior example where after a miscarriage, she transfers multiple embryos. So that way it lowers her shot of a miscarriage. Here it is saying, hey, let's just do a single one because we think we've got it, the way the technology we're using. And here it is, 40.5 weeks delivering a healthy baby. She takes her planned leave. It's not an unplanned leave that's 9 months, it's 4 months. She's happy, and she still has one smart cycle left remaining for future transfers. So you don't have the emotional roller coaster of the miscarriage. You have, let's say, probably more healthy babies, lower costs ultimately because they're not in the NICU, not unexpected, let's say, twins. So this, I'd argue, relative to the alternative, is an unrivaled model. This does strike me as you're doing something different than the rest. This is special. And you can see it with their results. You can see it with their outcomes, where they talk about how their miscarriage rate relative to the industry is about 26% lower. This is a national average, 26% lower than the national average. Their live birth rate, 25% higher. Their 72% lower IVF multiples rate. The example, the example from before, where you were looking to have a child, but now you have twins because you were using IVF multiple embryos. Here it is, they're getting it much better sort of hit rate, and this transfers ultimately into the customers, the patients, effectively saying, hey, I love this service. An NPS score of plus 81. Customers love it. And they also have this integrated Progyny RX, effectively their prescription service, their pharmacy experience, which is critical. It's critical to get this integrated. I believe about 74% of their existing clients integrate and pay up for this sort of pharmacy experience as well. The reason why it's so important is getting a timely prescription is critical when you're dealing with cycles. And typically when you're looking at a prescription, you can have long wait times. You can have 1 to 2 wait times in terms of getting the approvals from everyone, especially if it's a costly process. Whereas here it is, you're working with their pharmacy benefits manager. You're going to get this in short order. Instead of waiting that 1 to 2 weeks, you can get it, the client can get it when she needs it to deliver, to keep her on the right path, so that way you don't miss a cycle. So ultimately, not only are you looking at an unrivaled experience, but critically, you're looking at an unrivaled outcome. And that's the key aspect. You have to have a better outcome for the customers to make sure this is a renewable, sustainable business model. And they talk about how Progyny is the only company generating these types of outcomes, which really does make it stand out, in my opinion. And as you look, just taking a step back, you look at their revenue growth, you're looking at their adjusted EBITDA profitability, you talk about their customer retention and revenue visibility. You look at these things, and just a quick snapshot, when you see a chart like this for revenue, this means you're probably looking at something special, especially when it's not projections. These are historic results with only a projection for 21. That is a nice chart. I love seeing, straight up and to the right, that's a beautiful chart to me. When I start seeing that, that makes me go, okay, what's going on here that sort of justifies 50% year-over-year growth and 100% the prior year. And so they're saying, look, because we have 100% retention, we have very strong revenue visibility, and over time, as we get scale, we can leverage some of our fixed costs like G&A, and so then we can have better and better margins over time, such as mid-teens profitability margins. So these are the results of an unrivaled company. That's at least what I'm looking at, and the outcomes certainly suggest it as well. But this company is not without risks, and one should go to the SEC filings to see the full risks, but some of them that sort of stand out to me is, one is customer concentration, where you have 2 customers that represent a little over a third of their business. One's 18% of their revenue, the other's 17%. I would imagine that might be a Google or Microsoft, one of these major companies that employs many, many people, thousands and thousands of people. Another key aspect of this business model to consider is that it's utilization based. And so if you have a significant reduction in the number of members using their solutions, that could adversely affect their business and financial conditions. We'll talk about that in a second, because, for example, if people get scared of COVID, or if there's a general contraction in the economy and people say, hey, I'm not sure if I'm going to be employed, it's a utilization-based model. So if people say, hey, you know what, I'm not necessarily looking to make this step, you will see a decline. So this is a little more cyclical than you'd first expect. That they have been able to post up some fantastic numbers. But most recently, in their most recent quarterly result, they talked about how they saw unusual patterns in appointing scheduling, resulting in that July and August utilization could be somewhat lower than expected. I suspect this is largely tied to COVID, where people were uncertain. You have new strains. Do I really want to make this appointment in the coming weeks? While we believe this is a short-term anomaly and are already seeing indications that member activity is returning to levels that are closer to what we would expect, we are adjusting our expectations slightly for second half of the year, which will impact our third quarter and full year guidance. So this gets to the fact that this is ultimately a utilization-based business. That said, they're still projecting very strong results, effectively projecting 50% growth this next year, getting to over $500 million in revenue and about $70 million in EBITDA. That's what they're guiding to for this year, which is very, very strong results. So now the next question is, well, what are your thoughts on valuation? Because every company you look at, you need to consider that valuation, because just because you have a strong company, with strong growth, you could have valuation come and crush it. You can overpay for things that result in lackluster returns over time. So let's understand what the valuation is in just 1 second. First, a quick plug, where once again, my name is Daniel. You're watching Unrivaled Investing. If this is your first time tuning in, I do appreciate that thumbs up and hitting that subscribe button. If you want to follow my personal journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the last week of the month, I call out a potential multi-bagger type of stock that I think could potentially go up hundreds or even thousands of percent over time. Also, each weekend, I have weekly updates. We're building a community on Discord as well for those that would like to join. That's at unrivaledinvesting.com. Let's understand their valuation right now as we dig in. And so as I look at their valuation, this $48 stock price is based on the fact that they just reported earnings and the stock did take a little under a 10% drop since then. So it's around 48 bucks a share, might be higher or lower. So around $4.8 billion valuation. You can see they've grown revenue quite significantly over the last few years, from 100 million to about 500 million. That's effectively their guidance for this year, around 50% growth. I'm penciling out 48 to 55% growth. I'm saying longer term, this business could potentially get 15 to 17% operating margins. That's based on where they are today, based on management's feedback, based on the directions their margins are going into. So effectively saying this is what investors could value them off of in the future, what this business could look like in the future. And I'm using a 5-year model when I think about these things, because I try to be a long-term investor. I'm thinking 5 years, because in the short term, month, couple of months, even a couple of quarters, it's short term. Valuation can drive most of your return in short time frames, but over longer term time frames, it's the fundamentals that really drive it. And that's the reason why it's so important to understand how all these different variables play out. And so here it is, effectively based on their current results and assuming optimized margins. So looking at their guidance and potentially optimized margins, you're potentially trading at somewhere between 70 and, let's say, mid 80s. So 70 to 80 times earnings, optimized earnings. And so then what's this potential growth over the next few years? I'm penciling out a range between 30 and 40% on an annualized basis in the ensuing years, which gets you to about 1.5 billion in revenue to about 2 billion in revenue over the next few years, over the next 5 years. And then using these same optimized margins, what's the end multiple 5 years from now? So a range of, let's say, 25 to 40 times multiple. And so this does effectively assume some multiple compression over time. And that's what I think you're going to see with a lot of companies over time, is that over time, you start off with giving a really lofty multiple, but over time, you are going to be valued on your earnings. You're going to be expected, okay, let's value this business on the cash flow you're expected to generate along with your growth. And so I did a whole separate video on how to think about valuation multiples exclusive for Journey subscribers. And so here it is. Assume a range of about 25 to 40 times. And if you have different assumptions, I'd love to hear it in the commentary below. So based on this range of assumptions, that effectively gets you down negative 15% from here versus about 100% plus. Now keep in mind, a lot of things can change this. For example, if one of their big customers leaves, that definitely upsets this sort of outlook. So that is a fragile point with this business model. And this is a framework. This is a hypothetical framework. Of course, the stock price could go way higher or way lower. And so I look at this and say, what, this is pretty interesting. I do like the fact that this company smells unrivaled to me. And so I like the setup. Progyny is getting a thumbs up from me. PGNY is the stock. That said, I personally think I can find better plays out there For example, I've called out for my Unrivaled Investing Journey subscribers another healthcare play, related to the healthcare industry that's growing faster than Progyny. So Progyny is growing about 50%. This healthcare play that I'm looking at is growing about 80% and trades at around 3 times sales versus this company which trades at 9 times sales, and yet they have the same level of profitability. And so that's the reason why it's so important to turn over so many rocks, is I think you find things where you go like, wait a second, that's a potential anomaly here in terms of that growth rate and multiple versus what I'm seeing elsewhere. But overall, I like what I'm seeing with Progyny. Unrivaled Investing Journey subscribers do know about the potential multi-baggers that I've called out, like this July, healthcare play. But overall, Progyny, I like it. I think the company's unrivaled. If you have thoughts on Progyny, I'd love to hear it in the commentary below, so please leave a comment. If this is your first time tuning in, please make a point of subscribing and hitting that thumbs up button. Thanks so much for watching.